While retail traders spend April 2026 chasing the latest AI momentum stocks, billions of dollars are quietly locking into the ground. A structural shift just closed in the physical gold mining sector while the public was looking elsewhere. The textbooks dictate a specific rule for this environment. When interest rates sit consistently high, right now in that 3.5 to 3.75% range, gold is supposed to struggle. Investors can typically find better yield in treasury bonds, making physical metal less attractive. But this graph shows exactly how that rule has shattered. Interest rates hold flat, while gold sharply diverges, climbing aggressively toward the $5,000 mark. Domestically, U.S. inflation remains persistent. Globally, Eastern central banks are executing aggressive de-dollarization, forming a massive buying block that places a consistent floor beneath the metal. This environment triggered the $2.13 billion acquisition of G2 Goldfields by G Mining Ventures. Major players recognize the math has changed, and they are moving to consolidate assets. Understanding the mechanics of this specific deal reveals how institutional money operates today. They are looking past textbook economic theory to hoard consolidated hard assets before the rest of the market catches on. To see why G Mining dropped over $2 billion, we have to look at the physical reality of the asset. This deal centers on the dense jungle of the Oko region in Guyana. This map shows the immediate physical synergy. Before today, two separate companies operated adjacent plots. By acquiring G2, G Mining merges the Oko West project with Oko Ghani, creating a single contiguous land package spanning over 360 square kilometers. In the mining sector, the spot price of gold is often secondary to all-in sustaining costs, or AISC. This measures the total expense of extracting each ounce. This waterfall chart demonstrates how combining these operations creates a steep drop in overhead, projecting over $710 million in capital and operating cost savings. With the friction of borders and duplicate infrastructure removed, this new megamine is scaled to yield over 500,000 ounces of gold annually. We are seeing this scramble for underground value across the industry. Just recently, Kinross Gold had to warn its shareholders to reject a mini-tender offer, a tactic where buyers try to snatch up undervalued shares below market price while they are still cheap. The profit engine in 2026 relies on slashing operational costs through these massive unified land packages. The big players know the replacement cost for gold in the ground is skyrocketing, and they are buying up the dirt to control the most efficient assets. Retail investors typically gain exposure to gold by purchasing passive ETFs like GLD. That institutional wealth behaves differently during a corporate merger of this scale. In the G Mining deal, G2 shareholders received a combination of standard stock, shares in a new spinner-up company called G3, and contingent value rights, or CVRs. A CVR acts as a secondary contract that grants the holder an additional payout if a specific milestone is met. This flowchart illustrates how professional investors hedge their bets. A single investment splits into two distinct streams. Investors capture the immediate premium of the acquisition payout while holding on to a future-dated payout box. If the new megamine hits future resource discovery targets, that CVR could pay out an additional $200 million. This is a sharp contrast to how mining stocks have traded over the last 10 years. Even as the physical price of gold climbed, the miners themselves routinely underperformed, weighed down by heavy debt loads and energy costs. But the G Mining acquisition proves that the sector is actively repairing its balance sheets. Moving capital away from expensive, speculative exploration and into corporate consolidation rapidly expands profit margins. Smart money is engineering risk-free upside through complex financial structures like CVRs. They are positioning themselves to capture the value created by these mergers, rather than just passively hoping the metal's price goes up. For the American investor, the impact of a jungle megamine ultimately comes back to Washington. Right now, the Federal Reserve is locked in a wait-and-see holding pattern on interest rates. This creates two immediate scenarios. If the Fed cuts rates later this summer, the opportunity cost of holding gold drops. The price could go parabolic, multiplying the profit margins of this newly expanded G Mining operation. Conversely, if the Fed remains hawkish to fight inflation, the sheer scale of this terraced open-pit mine acts as a defensive fortress. The low-cost nature of this Tier 1 asset ensures the company stays profitable, even as smaller, debt-heavy miners fail under the pressure of high rates. The era of finding easy gold is over. Survival and growth in the mining sector now rely on building these massive, low-cost operational hubs. You need to ask yourself if your personal portfolio is positioned to survive a prolonged, sticky inflation environment. Major central banks have placed a floor under the market, making consolidation a necessary safe haven. If you want to understand how to navigate this shift, hit the like button, subscribe, and access our full 2026 Gold Outlook report in the description below.